Afternoon, and everyone, and thank you for attending our sell-side panel. Impact of FRTB on capital and liquidity, front office, and risk management perspective. So yes, since FRTB was first published in January 2016, it was on a lot of people's minds and in many people's dreams, or I should say nightmares. So we know that FRTB stands for Fundamental Review of Trading Books, but what it really is it another four-letter F word or something much more sinister? The panel today will try to answer this and many other questions. So we have three very distinguished financial executives here today. Let me introduce them. To the left of me is Gordon Leo, Head of Global Risk Analytics with HSBC North America. Then we have Richard O'Connell, Head of Risk Appetite for Global Markets and Combined U.S. Operations with Credit Suisse. Last but not least, Melvin John, Director with Global Risk Management, Citigroup. So as we promised, we will try to cover FRTB from a front office perspective, from risk management perspective, also from analytics perspective. How we decided to structure the panel, we decided that we will try to answer as many questions which we come up with, and then we will have 10 minutes Q&A sessions where you will ask us other questions if you didn't hear them coming from us. So without further ado, let me start with the first topic, which is current market risk capital regime in relation to FRTB. And first I would like to ask Melvin to give us a quick summary of the current market risk capital regime.
Sure, thanks Dmitry. I think for those of us who've been familiar with trading activities and the market risk capital frameworks over time, what we've actually seeing right now is sort of an evolution of how to capitalize the various risks in the trading book. But fundamentally when initially, like for example 10 years back, when in the US banks, market risk from a trading perspective was primarily VAR as a key measure, as well as even in most of the credit sensitive and equity driven books, we also had measures like event risk, which capitalized some of the specific event driven losses that we would have in those businesses. For example, credit migration risk and M&A arbitrage losses that you would have in the equity book. So we had a very basic framework that pretty much seemed to capitalize all of the key risks that we have. Basel 2.5 and 3 came and introduced a much more robust capital measurement framework, which expanded VAR to stress VAR, which was meant to capitalize losses during a stress window. We formalized the event risk model for credit risk, for the credit book, into what we call the IRC measure, which is meant to capitalize default and downgrade risk that we have in the book. We capitalized correlation risk to the CRM measure, which is nothing but a repricing of our correlation book based on simulating various factors such as recovery and repricing of the tranches. We had standardized measures for securitization, what we call the SFA and the SSFA approach. So overall, and the market risk framework, you also have for non-modeled risk, the standardized SSMR framework. So when that came about, people were obviously, there was a lot of concern about the double counting that existed in some of these measures, and I think that was an initial concern, and people got over that. We lived through that concern about double counting, especially for firms that in the US that had a significant mortgage book. There was a clear double counting between VAR and SVAR because the volatilities in both these cases were pretty much the same that were creating losses. So I think we lived through that scenario, we lived through all those issues around that, and now comes FRTB, which on one side was trying to address some of these duplications, but on the other side has made life a lot more punitive for the markets business. So I think we will get into the specifics of FRTB, I guess, but I think what we're seeing essentially is capitalizing the trading activity more and more, and at some point we all wonder like where it's going to go eventually, right? But I think from my experience, I think the markets and the business will live through this cycle as well, given all the concerns we have. So I think that's where we are right now.
Okay. Thank you, Melvin. Additional question to Gordon. What other regulations are currently being implemented and finalized and how they're related to FRTB.
Yeah, thank you, Dmitry. I think this is a very large question, depends on different regulators. So certainly there's global regulations, there are countries, there are also different union like EU in there. So if I list some relative that's regulation being implemented right now, so let's see, there's certainly we have the liquidity, that's coverage. So that one is going to be impact with this one as well, right? So to see how much, what's liquidity we've been identifying the products in the FRTB. So the other one see the Basel from the Basel committee. So Basel 4, so we can see. So that will be very much try to address the balance between the banking book and the trading book. So they try to see taking out any arbitrage opportunity if you put into banking book or trading book. There's a lot of it. For the FRTB is part of actually in the Basel 4 in there. So we do have the other ones like the CFI, GSIFs. So that's just institutional. Those are globally that's significant institutions. So that kind asking different TLACs, asking different level going to be see if unwinding. So what's going to happen of your capital? So they are all emphasized in the capital itself. There's a data issue. Certainly that's regulation BCBS 239. So they're all related together. So let's say for US one, certainly we didn't forget about the US CCAR. So that's the capital. If we see the CCAR may be separate with the fundamental review trading book, but they are related because there's a component how you calculate the capital. So if there's FRTB, your CCAR for trading book calculation is going to be calculated a similar way. So there are also the CVA is going to be separately proposed. So they're all this combined together. I think it's agree with Melvin was saying. So it's making the more trading activity is much more complicated. So it's not only the trading itself is complicated, but the regulation makes it complicated. You have to satisfy all the different regulations and calculate the capital. Some of it is overlapping. Some of it could be contradicting to there. So the Basel IV one saying if you're moving from banking book to trading book or vice versa, if you do have some capital reduction, you have the capital regional capital. So you can reduce the capital for this. This one, I think, there's some contradiction in between. So they are all actually linked together, some of it.
Thank you, Gordon. Next question to Richard. Richard, you work for international banks. So given that FRTB is subject to multiple regulatory jurisdictions, what are the main pain points?
Well, I'd say that the biggest pain point from being an international bank subject to two regulators is that last I heard there was generally a wide move to extend adoption out another year, except, of course, Switzerland wanted to adopt on the current schedule, which would extend to all of Credit Suisse's operations, including in the U.S., because, of course, your IHC is part of your consolidated capital regime and is separately governed by the Fed and subject to the Fed CCAR regime. So it's really the best of all possible worlds to have to both be subject to CCAR and early adopt FRTB. So there's that consideration that's somewhat unique to the Swiss regulators' approach to early adoption. But even then, I've found there's a range of understanding and interpretations and even philosophies in the regulatory capital world. You might talk to somebody on one side looking at the US rule book and say, yep, this seems fairly clear. You can do X but not Y. And someone might say, no, we're going to look at it over here from like the international Basel III and we have a different approach. And some people care about the spirit of the law, some care about the letter. So there's, at least I think with FRTB, once the US finally does adopt it, some of that will actually be better, because what FRTB does is it provides very specific and concrete requirements for internal model approval. And that is really what FRTB attempted to solve. It said, look, different regulators are applying different standards for model approval. The P&L attribution test, the real price data, all these things provide very quantitative and black and white criteria for model approval. So it does somewhat level the playing field.
Okay. Thanks, Richard. Our next big topic is the main challenges in FRTB implementation. It's really, really big topic. We actually Quantifi just published a paper you can find on our website, where we go about, as we think, like a broad range of these challenges. Today, with the panel, we would like to cover just some of them. So let me start with Gordon and just ask, can you compare complexity of implementation between AMA and SA, given that you have to implement SA anyway? Is AMA even worth it? Please.
Right, certainly. So if from the modeling perspective, certainly we would see internal model is more complicated. So I'm sure many people are saying now the standardized is going to be more complicated. I think they are all complicated. So it's nothing, the standardized is simple or not. So think about for internal model, you have model, you do the risk factor reduced one, do passing the P&L attribution, you passing your VAR back testing, you calculate using expected shortfall, but you have for different product group and different liquidity coming together, you cannot hedge between the different products, and there are long model more products in there. You have RC in this one, you have residual. So it's quite complicated. But this one is a scope, right? So you will see you define scope is in model, in the internal model or not. So there's an option for those. For standardized approach, you have no choice. So every single task you need to do that. And when you do that one, you have to see, you need to calculate sensitivity. Some of it, I don't know, you're able to calculate. And you have to do the curvature. You have to do all the different residuals in there. So the standardized approach is not really standardized. Different banks can use different model in there. So still have the difference in there. Even define is the same. So I would say they are all quite difficult. For standardized approach, you have to do it, right? You have no choice, you have to run that. But to do a better risk management, or you try to better allocate your RWA more effectively, you still need to do internal model one. Of course, worse or not, it still depends on your desire to manage risk better. And from capital perspective, what's the ratio? So finalize, if ratio is 100%, I think it's another bank probably don't do it anymore. And they could do their different risk management, they may not apply for an internal model approach. So, but if the ratio is going to drop to 90%, 95, or 85, 75, I'm sure it's very attractive. So the final ratio is going to be make it very worse or not comparison. So I think that's the final say to this.
Thank you, Gordon. Richard, a question for you. What is the biggest challenge in bringing front office risk metrics in line with risk management risk metrics?
I think the biggest challenge, okay, so this is like one subset of the P&L attribution test. Easier to talk about the P&L attribution test, which says makes a relatively benign sounding request that your risk times your sensitivity should resemble your P&L. So if you're long the market and the market goes up, you should make money. Getting that right for a broker-dealer book with large offsetting positions is much harder than it sounds. And it's both of those things. It's both, you got to get your risk right and your market move right. Within the risk side, just, you can say, oh, well, was this to the spot curve or the par curve? Did you use forward rates or this? Because over here on the backside where we're multiplying, we're just using a swap rate. So there's issues of making sure all your conventions are lined up correctly. And then really, it's not just, once you get that fixed, you're going to still find there's methodology issues. If on the backside you've got, say, one proxy index for corporate credit or several proxy indices, that may not be nearly granular enough to pass P&L attribution for your corporate book, because these indices are essentially reflect the broad movement of the entire market. You've got a bespoke book of longs and shorts that should be generating alpha on a normal basis, just because the cheap stuff goes up and the rich stuff goes down. And then finally, once you've addressed your conventions and your risk factors that give you sufficient granularity to match up your portfolio dynamics, the last bit is going to be extending the number of sensitivities and going from first order to second and third order contributions. I always point out that if you look at an interest rate swap book, which has, the whole role of broker-dealers is to intermediate risk between customers. We're not taking outright risk. So if you look at a typical swap book, you have all these longs and all these offsetting shorts with different coupons and different settlement dates and different convention and different calendars and so forth. I mean, it's like you're receiving on the you're receiving for December 20th on the London calendar, you're paying for December 25th on the New York and London calendar, or something like that. But that's the risk we intermediate. That's the role of a broker-dealer. Getting your P&L attribution right, you say, well, I made $1 million today, or I made $2 million or $3 million today. When you look at the entirety of that book, all the longs where you're receiving may have made $1 billion, and all the payers may have lost $997 million. So net $3 million, which is exactly what you do on the front office side. That's, you're hedged. $3 million net P&L. Cranking the sensitivities through a risk system to get your plus 1 billion minus 997 to come down to 3 million plus or minus maybe a few hundred thousand is incredibly hard. You're not doing that with just 5-point partials on your swap curve, or 10-point partials, or maybe even 20-point. You may find yourself doing, monthly or even daily partials on your swap curve in order to get the required granularity, so that your swap book, just vanilla offsetting swaps, that P&L lines up with your actual P&L at P&L attribution thresholds.
Very interesting. Thank you, Richard. Melvin, what do you think are biggest challenges on IT side?
Well, I'm not an IT expert, but I can definitely talk about some of the challenges that the U.S. banks are facing. As some of you may know, it's typically in the U.S., the Fed has allowed banks to use both historical simulation as well as Monte Carlo. So at Citigroup, we were one of the only U.S. banks to use Monte Carlo for VAR. And at this point now, we are forced to move to historical simulation, which is not something that we've done so far. So I guess overall, from a large bank perspective, given the fact that you got multiple front office systems that can price trade positions and trades slightly differently, there is a move to now integrate everything into a single pricing library. I think that's one of the biggest challenges on the front office, to get everything siloed into one system that can do that, so that you can sort of leverage the benefit that a model approved pricing or a pricing model that can work well can be utilized across the board. Data, I guess, data, especially when you're a bank that is moving from Monte Carlo to historical, you need to have the time series of information for the last 10 years to actually replicate the VAR calculation in the current regime. And plus, given the fact that you got all these multiple, I guess 90 to 120 different computations you have to do per desk, Overall, I think it makes it a big integration, data, and computational challenge. I mean, if I have to just summarize it very quickly, I think along with the fact that some of the desk structures may change, right, and all of the sort of domino effects that come along with that, right? I mean, your limit structures change. So I think it's not just a calculation issue, but also an organizational issue around how you're going to reorganize your entire markets business and also the systems that need to support that. So I think it's a very long list, but I'm trying my best to summarize it in like as short as I can, actually.
Thank you. Thank you. Let's talk now about dialogue between banks and regulators and possible delays. So my first question to Richard. Given that some jurisdictions like Australia already announced their delays in implementing FRTB, do we expect US to do the same? And after Richard answer this, I would like everyone to jump in and maybe have some conversation about this. But Richard, please go first.
Yes, well, I don't see, well, first of all, the U.S. adopted Basel III later than other areas. They implemented their own version of Basel III. And so you've got that thing in the past as a benchmark. Additionally, there is the U.S. regime of CCAR that I think pretty robustly ensures that the major broker-dealers are not going to fail based on the amount of capital they have to hold. On both of those points, I would not expect the U.S. to rush forward and embrace this because they didn't do that in the past, and also I would argue the banks are safe at the moment based on CCAR. So, but this is not, in my opinion. We'll see what happens.
Gordon, what do you think?
I would say this is the point I hope we could see. We are actually consistent globally. So we're asking the global bank to be consistent from different jurisdictions. This is the time we see global regulator, they should be standing together, they be consistent. That will make everyone's life much easier, even though we know it's not possible in here. So certainly, if we do have seen, I do agree with Richard was saying, the U.S. has much more. So it itself is not on the same page. So U.S. has moving forward with stress testing, the CCAR, the DFAST much earlier than anyone else, and also U.S. implemented the initial margin using the same method. That same method actually was very close to our standardized approach. And then some modification, but basic idea is exactly the same. So it's based on there is ready for FRTB standardized approach. So I would say the U.S. I wouldn't be surprised the coming a little bit late or just like previously, and with some modification. So it's, in general should be very close to this standard. There could be some delays in there or modification, as U.S. we always do, right? So.
Okay, thank you, Melvin. What?
Oh yes, I mean, coming from one of the large U.S. banks, I think the sense that I get talking to our markets heads and all the various businesses and risk. I mean, I think yes, there could be a timing delay given when you look at what the U.S. is doing compared to what's happening in Europe as well as in Canada, which seems to be quite ahead. But at the same time, I don't think people are standing still and not doing anything. I think we are, from an implementation point of view, we have parallel runs going on. There's active budgets being allocated even into next year to make sure that we are ready for FRTB. I think this goes back to our readiness question, but also more fundamentally, even the businesses have started thinking ahead in terms of how to structure their portfolios, how to structure trades going forward into the FRTB regime. So I think overall, I believe that we're not standing still. We probably have a little bit of a benefit to see how this works across the world before we start to actually go live. But I think the businesses are fundamentally getting ready for it. I think there's no doubt about that. And in fact, even today, I came here after having a discussion with our correlation business because there is this the thought process that some of our businesses actually may go away, but I think the businesses are actually talking otherwise. I think there is no decision to sort of de-scope or reduce any of our existing portfolios. I think they are just getting ready with new structuring techniques to make sure we can move into the FRTB framework. And I think that's the mode that we're in here.
Okay. Thank you, Melvin. Actually, what you started talking about is the topic of our next topic is impact on businesses. And my first question is to Richard. How do you think FRTB will impact the buy side and also other financial institutions which are not directly subject to the regulation?
Well, I think the ease, okay, it's going to affect them in a lot of ways. Like capital requirements for certain products will go up. Now, some products I think will just go away and some will reprice. Asian options, let's say, Asian options where it's, say, average of a price over time make a lot of sense for, let's say, airlines that buy fuel every month with regularity. That's exactly what you would want to hedge with an Asian option. There's a social function for these options. Even if you cannot get your model to pass FRTB, these options will exist. Exotic options that are built specifically to make highly leveraged bets, I think we'll find those don't have a social purpose, and when they fail FRTB, they're just going to go away. So some exotics, some products will go away, some will live on. Of those that live on, some of these are going to have higher capital requirements than before. For example, private label securitizations probably have higher capital requirements under the FRTB. When you think of, so now how does that react in the market? I mean, I think about market pricing as you've got demand, you've got yield, and you have bid offer. Just because capital requirements go up, you're not going to see broker-dealers say, well, we're just going to have to hold more capital and make less money on this activity. They're going to have to make up for that higher capital requirement with a higher bid offer, but the customers are going to look at the bid offer and essentially the liquidity premium in the asset and demand a higher yield on the asset in order to purchase it in the first place. Because if you have, say, a 2-year holding period in time in mind when you're purchasing the asset, you got to take out the entry and exit costs on this. So to make up for the higher entry and exit costs, you need a higher yield over 2 years, which then goes back to where is demand for this asset that you are then selling to somebody. You trace this through and you just realize the only money coming into the securitization market at the front is homeowners or people who have taken out loans who get securitized. So you'll see higher rates there. Now this is all triangulation here. It's all these pieces are going to move. You don't know where the equilibrium is, but I would estimate higher yields and higher bid offer.
I would just add, I completely agree. I think it's additional just and the comment is that I think it's financial industry will always be innovative. I'm sure with this the new rule coming here, so it will be starting. There will be some innovation to getting higher return, and hopefully some good products could come in and based on this rule. So there will be some products going away. Some will be some new products will be coming. At the same time, I do see there could be some issue for the little bit high yield, and also for some non-major currency countries, the liquidity could be dry a little bit on those products as well. So there's some comments could be here.
I think I agree in principle to what both Rich and Colin said. I think overall the discussions around optimizing returns kind of goes back to 3 points, like how can we increase our revenue at the same time reduce our risk, and a lot of that risk reduction is going to be, we're going to see that through the various ways in which we can structure our products better, reduce basis risk, which can be pretty punitive in the FRTB framework, actively hedge or dynamically hedge more books than we normally do. So I think from a trading perspective, you're going to see a slightly better management of risk overall, much more tighter limit framework, I guess, as well, to aid people to keep their overall risk below a certain threshold. So I think, by the same time, like even when the CVA capital framework came around, we actually did see some of the CVA charges being, sort of passed on to the clients as well. So I think these capital charges would, in theory, if the aim is to sort of increase returns, reduce risks, therefore my overall return on Basel capital is still intact, then I think you'll have to pass on some cost to the customer as well as take on some more active hedging approaches. That could be innovative in some instances as well. So, yeah.
Okay, thank you. I would like to ask Gordon, as the person in charge of analytics implementation in HSBC. So, taking into account all the implementation issues, do you think banks, maybe not the biggest, maybe second tier, will build their own systems for FRTB, or will they go for some external solution?
Yeah, I would say this one. For the larger banks and institutions, they probably will do their own. So that's give you a lot of leeway internally, using internal data, and your backtesting, everything could be more suitable for your own. But I would say for smaller one, even medium-sized, and given the complexity, given the data collection, everything could be so difficult, and you have to verify all the data. You're getting, if the non-modelable, you're getting like some illiquid products. You have got the monthly, at least the 24. So there's a lot of threshold that you have to cross and to convince your model is going to be good, even for standardized approach. So it's quite complicated. I would expect many more banks will be medium-sized and smaller banks will be using external solutions. So if there are some opportunities right there, compared with previous VAR or even with stress VAR, RC, IDRC, those kind of things. So current infrastructure certainly is relatively simpler. So the new one is going to be more complicated, and the implementation, validation, everything is going to be, you drop one and you have to make sure even you drop the internal model ones, you have to keep backtesting, calculating, in case you get out of the window of that backtesting, right? So that's going to be continuous. So that's calculation, I would say the external solution will be, probably has much more chance than before.
Okay, thank you. Before we go to Q&A session, one last question, which I would like to ask all panelists. Is your firm ready? Who wants to go first? Maybe Gordon, because, okay.
Yeah. Well, this is the model starting from distance, right? So
yeah, exactly.
I think it's for HSBC, certainly we participate pretty much every single QS, and we run our testing, we did our, see where's the gap, where it need to be invested, and where system should be ready. I think in that sense, we are ready, but of course, will be ready until it's really needed to be ready. So the system, actually the money spending in there, the calculation engine being there, all the infrastructure, and certainly is in progress. So I wouldn't say we are ready, but I would say the technical perspective and in the psychology perspective, and we are ready, and just not physically ready now.
That's a nice answer. Yeah,
I'd say Credit Suisse is likewise. Credit Suisse is not ready today. Of course, it would be foolish to actually have committed all the resources to bring models up to whatever level of approval is required when we don't even know what that level is. I mean, the P&L attribution test is still being hashed out. The whistle has blown. FRTB is finalized, except for minor calibrations. But those minor calibrations could have a very material impact on your spend for IT and systems. So we're not ready right now. I think as FRTB finalizes, that will probably change some thinking, but I absolutely believe we'll be ready when go live occurs.
No, I think from Citi's perspective, I mean, given that Citi being a huge institution, even to move a small initiative through is not that simple. So I think on something like FRTB, one of the positives that we see is that there is significant investment from the business because unlike when Basel 2.5 came along, where it was money coming from the risk budget, the key aspect here is it is the global markets business that is really actually investing into this activity. I mean, all the budget for FRTB right now is directly from the markets business, which means that the front office is taking a lot more onus in getting this, leading this initiative and driving this for the firm. So I think in terms of readiness, I think yes, there is a very active program office, project management function, the technology functions, analytics, they're all involved. I mean, they produce quarterly numbers, I guess monthly numbers. In parallel, maybe all the plumbing is not really up to speed. We are going with whatever base case assumptions that we have right now, and we're not waiting for everything to get finalized. I mean, we are going with our set of assumptions, and more fundamentally, one being that if we are currently approved for our specific risk model under IRC, and we would have the same approval in going forward as well. So I think with those assumptions, people are getting ready, and I think, like I said, even the businesses have already started discussing about optimization and structuring and trying to sort of, how to hedge the book more effectively, which probably was never thought to this level of extent. So I think the thought process is there, the drive is there. It looks like money is also being allocated given the environment we are in right now. So I think we will get, obviously, we have no choice but to be ready. So yeah.
Let me now invite the audience to ask questions. So I think, you should raise the hand. And,
questions to the panels.
and
Han Jian from State Street. Question to the panel is, Richard talked about the challenge of the P&L attributions. In a hypothetical situation that the front office and the risk is sharing the same pricing libraries, same database, how will that, how do we justify that in terms of risk being independent? What would be the right argument to say that's acceptable, and what kind of governance has to be go around it? So therefore, this kind of sharing, cost-cutting type of arrangement is acceptable in the eyes of the regulators. A very specific question would be that if I have the internal marks on all the trades, and I can establish the proper trading volume, and is that enough to determine that it's a tradable market risk factor without actually going to a third party to find another mark to justify it? Thank you.
would like to take it?
Well, my first observation is that there's two levels of independence. There's both independence as like, do I independently verify the numbers? And then there's independence that risk is supposed to be worried about the risk and stewards of the capital of the firm and provide an independent check on activity by the front office. That latter function is the critical function of risk and is completely separate from do the numbers work. With regards to independence, look, if you're looking at, say, Apple stock, like I know how much Apple moved today, I know how many shares I held in position, that's my P&L. The proof that this is done correctly is that my P&L exactly matches my risk times my market move. And I think that is what needs to be relied upon to show that, sure, we're using the same database, we've got the same models hooked up, we're all unified front to back. The reason why it works is that it matches P&L. That is the entire point. If we did something independent that was different by construction, we won't match.
Yeah, I think this is Hongji. It's a great question you hear. So I think it's the first one I see. Even the same model, the front office certainly many times they don't depend on that for P&L. So if the liquid products and they take the price today and end of next day, so that's the difference of their P&L. The risk, the model itself, they will be used for generating risk and also generating hedging for that, right? So that's the front office. But if we're using the risk, using that generate any capital, certainly it will be make sure it works in the different scenarios. So that one, front office doesn't need to do that. So if it shocks, the curve might not be, could be very much arbitrageable. So if term structure shock, if you have basis shock, credit curve shocks, they may not be able to price some of it. So risk has to do independent, make sure the curve is no arbitrage condition that being taken out. And secondly, the risk using the data, you cannot be taken from the front office. Front office, many times, even if you do have the data, have the position, they probably mark the data today, but they're not going to mark all the points or the whole curve or every day, right? If there's no position in the front office, they're not going to see we're going to mark anyway in that case. So, but when you treat this one, historical data, so risk has to independently obtain that historical data. And many times you have to do slightly reduce the form of the model. Like some products is new today, but how do you get that from the stress period? You have to run the stress form, but it's nothing there in front of the system, or even the risk factor wasn't really there. So, but you need to do some reduced form comparison, how much going to scale up or down. So I would say even if they share the same library, the task is very different. The front office normally like is that running the smaller shocks, the daily P&L and daily the sensitivity going there. But the risk is clear about the tails, right, in that part. So particularly when you do the expected shortfall FRTB, it's not only just 99 percentile that one number or that number cares, the extreme case, the last one. So many times generate a lot of issues, a huge jump or huge down, so in the very tail. But this one will be embedded into your capital itself. So if possible, I would say you're not going to just testing your system, testing data, you should testing your expected shortfall itself to see if that expected shortfall is correct or not. So I would say that's using the same price reduce a lot of issue, but that's a large work still has to be done for those. But this is a very good question.
Yeah.
Thank you for this.
I agree. Next question, please.
Yes, thank you for the panel. Question is, as a side effect of FRTB coming on, being implemented, do you think that this may spur, for example, a all-to-all platforms and basically taking flows and trading of various products related away from the banks?
No,
Yeah,
like I said, I
would say
think
that could be.
and I think once FRTB hits, and I guess at that point we'll have a much more clearer realization if some businesses are really worth being in. The returns may not be optimal, it may not meet hurdle rates. So I think even Rich point, I mean, there could be certain pockets where products may not be feasible, but there is like banks like Citi, we still maintain markets being a big market maker in many activities globally. So there may be certain products where we may still have to continue to be a market maker, even though it may not be a profit generating business, because it provides local access and many other sort of other benefits. So I think honestly, from my personal opinion, I think right now there is no talk about discontinuing or getting out of any business, right? I don't see any of that indication from anyone. But I guess once the rule sets in and once the return hurdles are sort of evaluated, maybe we may see scaling down in some activity. But as a major market player, market maker, and globally, we don't just exit because of not meeting hurdles, because if it has other implications, provide local access and support a client's demand, we may still be in that market. So. Yeah.
Right, no, I agree. Just as a follow-up, essentially, I don't mean that the trading in various products will stop because banks can't do it. Just can move away someplace to other places, i.e. asset managers trading with asset managers, for example.
Right. If I add comments, I would say some of the products, I think both the panelists are already seeing, there could be change. I'm sure there's some of the products going to hedge funds, going to other the funds or some different institutions which is not regulated by this capital. There could be absolutely that kind of opportunity, as well as the products going away from the banks.
Next question.
For non-modelable risk factors, are you considering using external pricing mechanisms or some sort of consensus risk factor solutions provided externally? Granted, there will be some freeloaders. Would that be a problem for you, or is that something that you'd move ahead with?
If I add for this part, so there will be always have non-modelable products. I mean, the risk factors for the bank right now is already using, for non-modelable one, is using a stressed that condition to estimate how much capital going to be there. Right now, we're seeing the risk not in VaR that's required by PRA. I think U.S. many banks already adopt that, and certainly here will be have some risk not in VaR, risk not in the expected shortfall, and those can be using the stressed ones. So it could be external stress condition, what it's going to be, and it could be internally they do have some stress condition and how much going to be the change of the P&Ls that can be used for that non-modelable risk factor to do the capitalization for this, right?
I think we have time for one more question.
The debt fund that's usually today they are using a VaR as sort of an intraday VaR to monitor the intraday risk. So going forward with expected shortfall, given the amount of calculation, how much it takes, what would be the panel's recommendation as an intraday risk monitoring besides the usual sensitivities? What would be sort of aggregated risk measurement you think should be recommended and be used?
The intraday, I think, is very high standard. So I think it's mostly, even the banks is not using the live data for that day. So pretty much using yesterday's that data generated, you replace with today's position to monitor that intraday, how much going to be impact for your capital purpose. So I think it's the front office, if it's monitoring intraday, the P&L itself, that's a different story for that part. I would say it's very difficult to have that meaningful monitoring. But if you're using intraday position to calculate what could be impact based on yesterday's data and with yesterday's portfolio to run what would be the impact for your expected shortfall, you can still calculate. But if you want a true intraday, I don't know any bank can do that.
I think if I understand your question correctly, are you saying that are we going to discontinue the VaR front office? I mean, from my understanding, we're not shutting down the front office VaR calculation. That's still going to be used. Those models, those engines are still going to be used because fundamentally even the VaR measure is also used when we estimate haircuts in SFT and other collateralized transactions. So I think the VaR metric is not going away. I mean, we're going to have that as a tool, as a risk measure for the front office, even as it is today, but it's just that it won't be part of the capital measurement process, right? So from my understanding, Citi is not shutting down the VaR framework in the front office perspective.
Thank you. Let me say thank you to the panelists. I think it was great. And we have coffee break, so and you have opportunity to ask more questions to panelists.